Welcome back to the deep dive. Today we're navigating a topic that is, well, it's one of the most powerful legal instruments for wealth preservation in South Africa.
Mhm.
But it's also one of the most misunderstood and, frankly, misused. We're talking about the trust.
But that's a really essential distinction to make right at the top because, people see trusts as these complicated, maybe even shadowy legal container.
Right, for the super wealthy only.
Exactly. But there's so much more than that. Our sources show they're really the ultimate tool for generational planning, for robust asset protection. The core idea here isn't just about piling up assets.
No.
It's about safeguarding them, overseeing them responsibly, and making sure they benefit the people and the causes you actually value long after you're gone.
So our mission today is really to distill all of this complexity into some actionable clarity. We want to convert that information into tangible protection for you, our listener, and turn understanding into a lasting legacy.
And the benefits are uh, profoundly quantifiable when you get it right. We're talking about avoiding the huge pain points that just erode wealth.
Things like what specifically?
Well, costly probate delays, inefficient tax strategies that can just bleed an estate dry, and huge estate duty bills that can wipe out 20% of your life's work
Yeah.
just overnight. We have real numbers, real case studies that prove this.
Okay, let's jump right into that then. Section 1, the fundamental truths. You said quantifiable savings, not just theory. So let's start with the big one, estate duty. How does a trust save millions where a simple will would just fail?
It fundamentally changes where the asset is legally held.
Hmm.
You see, estate duty is the tax the government charges on the net value of your assets when you die.
And the rate is steep.
It's very steep, up to 25%.
Yeah.
A will manages assets that are in your estate. A trust manages assets outside of your estate.
So a good trust structure is almost like a freezer. It stops those assets from ever being assessed for that duty when you pass away.
Precisely. You just have to look at the Van Rensburg case. They had an estate valued at about R$22 million. By strategically moving assets into a trust over time, they froze that growth outside their personal estate.
And the saving was?
The planning saved them a staggering R$4.2 million in estate duty.
Wow.
And this wasn't theoretical money. It totally transformed the final inheritance. Instead of the heirs getting R$15.6 million, they received R$19.8 million.
Yeah, it's a 27% increase in what the next generation gets just through smart structuring. Incredible. Now, what about asset protection? That's the one everyone thinks of, but the sources suggest it's very easy to get wrong.
Oh, it's incredibly powerful, but it is fraught with danger if you're careless. And this is perfectly shown by the notorious Moodley case. This family tried the DIY route. They figured they could save maybe R$50,000 in legal fees.
And that mistake cost them.
It resulted in an R$8.6 million tax bill.
Wait, 8.6 million? How does using a trust badly result in such a catastrophic penalty? What did they actually do wrong?
In simple terms, they treated the trust like their personal bank account. They mixed personal and trust finances. They totally ignored the independence of the trustees, and they failed to file the proper tax returns.
I see.
So SARS successfully argued the trust was just a sham, an alter ego, they called it, of the founder, and they imposed these devastating penalties. It proves that good guidance saves millions, while DIY costs millions.
So the attempt to save R50,000 on professional fees cost them over 8.5 million rand. That's a brutal lesson in the ROI of getting proper expertise.
And beyond tax, trusts solve the huge problem of succession. If you're a business owner, a trust can prevent absolute chaos. We saw this with the de Villiers family.
Right.
They achieved a seamless, multi-generational transition of a massive R$500 million enterprise. The trust held the business equity, which let the trustees manage the transition smoothly. It avoided all that crippling family conflict and business disruption.
That continuity is just priceless, especially for a large operational business.
Yeah.
But trusts aren't only for these massive enterprises, are they?
No, absolutely not. They provide irreplaceable security in deeply personal situations. Take the Botha Special Needs Trust, for instance.
Mm-hmm.
It ensured lifetime care for a disabled beneficiary after their parents passed away. The structure protected that capital from being exploited or mismanaged. It guaranteed that person's financial security forever.
That is peace of mind you really can't put a price tag on.
You can't.
And circling back to ongoing wealth, you mentioned income tax savings. How does that work in simple terms?
It's a strategy called income splitting, and it's a huge long-term efficiency boost. If you as an individual earn R1 million in passive income, you're paying tax at your highest rate, up to 45%.
Right.
But a properly structured trust can distribute that income to different beneficiaries who might be on a lower tax rate or maybe even below the tax threshold entirely. For medium to large estates, this can save you our $50,000 to our $200,000 a year.
So we're not just talking about a one-off saving. This is an ongoing compounding benefit. It protects cash flow every single year.
Exactly. And over 30 years, that sustained efficiency adds up. You're looking at between our $1.5 million and our $6 million that stays with the family. That's pure cash flow retained just by managing where the income lands.
Okay, now let's talk about timing. Because there's a critical truth here, which is that timing is everything.
That's the fourth truth, and it's absolutely crucial, especially for protection against creditors. The optimal time to set up a trust is 5 to 10 years before you think you'll need it.
5 to 10 years before.
Yes, trusts established years before creditor claims come up offer robust protection. The courts see a legitimate purpose.
So if I'm a business owner, maybe I'm facing a potential lawsuit in 6 months. Setting up a trust right now is basically useless.
It's worse than useless. The sources are crystal clear on this. A trust created months before insolvency or a major lawsuit. It will fail completely.
Why?
The transaction will be challenged as a fraudulent transfer, as an attempt to defraud creditors. So advanced timely planning is the only planning that actually works.
That makes perfect sense. Setting it up when the wolf is at the door is too late. Let's pivot to Section 2. The cost of getting it wrong. It sounds like success versus disaster really hinges on the structure.
It absolutely does. Structure determines success. This is where most DIY attempts just fall apart. The failure often starts with just choosing the wrong type of trust.
You mentioned discretionary versus vesting trusts. For most people, that's just jargon. What's the real difference?
It all comes down to flexibility. Think of a vesting trust as rigid. It's pre-programmed. It says assets must go to person X at time Y. A discretionary trust gives the trustees the power, the discretion, to decide who gets what, when, and how much.
So the discretionary trust has the superpower, but it needs much more sophisticated management.
Exactly. That discretion is the protection superpower. It keeps beneficiaries from legally owning the assets, shielding them from creditors, from divorce claims. But that means the trustees have to be professional and follow every single rule.
And then there's how you fund it.
Right. The funding mechanism. Loan account versus donation. If you transfer assets via a loan, you had to charge interest or you risk huge tax problems later. If you donate, you face donations tax now. Doing it wrong can be a disaster.
And we have a chilling example of what happens when that structure is poor.
Right. The Botha litigation. It's just a tragic, classic case. The core issue was inadequate documentation and really vague provisions in the trust deed. This led to a years-long legal battle.
Costing the family how much?
Or $3 million in legal fees. And worse, it completely destroyed their relationships.
$3 million in legal fees just from sloppy paperwork at the start. What would it have cost to do it right?
To get the proper initial structure and professional guidance, it probably would have cost them around $150,000 upfront. That's a 2,000% ROI they missed out on.
Which really emphasizes the next point. Professional guidance isn't optional. It's risk management.
It's mandatory insurance. Almost every disaster case we looked at had one thing in common. Either no professional guidance or the founder just ignored the advice they were given.
Like the Moodley case.
Exactly. The DIY mistake cost $8.6 million. The professional fee to do it properly. Maybe you are $50,000 to $100,000. It's the highest ROI insurance you can buy.
So realistically, what does it cost to maintain a successful trust over, say, $5 million a year?
Annually, you're looking at a professional commitment of roughly $60,000 to $240,000. That covers professional trustees, a tax advisor, annual accounting.
Which sounds like a lot.
Until you compare it to potential losses of $500,000 to $10 million in avoidable disasters. Suddenly it looks like insurance with a 500% to 10,000% ROI. It's the cost of staying out of court.
So what are the absolute non-negotiables for any trust over $5 million?
4 things. If you miss them, you're inviting catastrophe. First, professional tax planning must happen pre-establishment. You have to model the capital gains and donations tax implications before you transfer anything.
That avoids those instant $500,000 tax mistakes.
Yes. Second, and this is critical, independent trustees are non-negotiable. This is vital to prevent that alter ego challenge.
Explain that. What is an alter ego challenge?
It's the argument SARS or a creditor uses to prove the trust isn't a separate entity, but just you wearing a funny hat. They say, you control everything, so the assets are still yours.
I see.
An independent professional trustee ensures that necessary distance. Without it, your asset protection fails.
Okay, what's number 3?
Third is annual tax compliance. The ITR-12T form must be filed every single year. The Moodley case showed that non-compliance costs thousands of % more than compliance.
And the last one.
Fourth, proper documentation. This isn't just filing the trust deed. It means keeping minute books, documenting every trustee decision, formal resolutions for every major transaction. The Botha case cost R $3 million because lawyers had to reconstruct 15 years of shoddy records.
That's an excellent breakdown. So let's move to Section 3, the trust decision matrix. When does all this complexity actually make sense for someone listening?
Well, it's just as important to know when not to use a trust. But it really makes sense in 4 key scenarios. First, large estates, R $10 million plus. The estate duty savings alone often exceed R $1 million to R $10 million over time. The numbers just demand it.
And the second one?
Second, business succession. It is essential for multi-generational businesses. You can't just transfer shares in a multi-million rand company through a will without triggering tax events or massive conflict.
Number 3.
Third, special needs dependents. A trust is irreplaceable for lifetime provision and protection from exploitation. And fourth, advanced asset protection. If you're a professional, a doctor, an engineer, a business owner with creditor risk, the protection value can be huge, R $5 million to R $30 million.
So conversely, when is it just not worth the hassle?
Definitely. If you have a small estate, under R $3.5 million, the annual cost will likely outweigh the minimal benefits. Since you're already under the basic exemption, it's a negative net outcome.
Okay.
Also, if you're in a simple situation, modest assets, few dependents, a civil will can do the job for a fraction of the cost.
And you mentioned family dynamics.
Crucially, if you have unstable family dynamics, a trust can become a vehicle for conflict. It can make things worse. A trust can't fix a broken family. It can only manage assets for a stable one.
That's brilliant clarity. Okay, Section 4. Moving from knowledge to action. This is all great information, but it's worthless without implementation. Where does someone even start?
You start by accepting you need a guide. Someone who specializes in synthesizing all the legal, tax, and governance parts into one cohesive strategy. That's where a dedicated trust consultant comes in.
To navigate the complexity.
Exactly, to navigate the tax modeling, the CGT, the donations tax, all of it. That's what a consultant does.
And that leads us directly to the profile of someone who specializes in this. Our source material highlights Lumka. She's a trust consultant whose whole mission is to simplify this exact process.
Yes, and her approach directly addresses the risks we've talked about. Working with a consultant like Lumka is essentially insurance against disaster. She provides that expert guidance, the deep understanding of trust law that prevents an R $8.6 million Moodley failure.
So she makes sure it's not just set up, but set up correctly to get those R $4.2 million savings we mentioned earlier.
That's it. She also provides simplified solutions and education, breaking down the jargon so you, the client, actually understand what's happening. And she takes a holistic approach, from setup to ongoing management, ensuring the trust stays compliant and effective year after year.
And she helps tailor the right structure for each person's specific needs.
Absolutely. Personalized solutions. Whether you're a business owner planning succession, or an individual trying to reduce estate duty, or a family securing your children's future, she specializes in helping the exact people who need this most.
So for our listeners who are just starting out and they need to figure out if the ROI is even there for them, what's a good first step?
For those people, she offers a great starting point. A 90-minute strategy call for R $3,700. It's all about discovery, education specific to your situation, and getting clear, tailored recommendations. It turns this abstract idea into a concrete blueprint.
Right, it gives you a defined path forward. So let's bring this all together in a final synthesis.
The choice is really laid bare for you. Inaction means paying millions in unnecessary taxes, like that 20% estate duty, and facing all that vulnerability. Action, with professional guidance, means multi-million rand preservation. Our numbers showed a potential net benefit of over R $9 million over 20 years. That's the difference between legacy and loss.
Which brings us to our final provocative thought. The cost of doing nothing isn't zero. It's measured in the millions lost to avoidable taxes, penalties, and maybe even the destruction of a family legacy through conflict.
The best time to act was 10 years ago. The second best time is today, while you still have the control to structure your legacy properly.
If you're ready to move from this powerful knowledge to actual implementation and secure your legacy with confidence, we strongly encourage you to explore your options.
And for those ready to connect with a trusted guide, you can find trust consultant Lumka and learn more about her services, including that vital strategy call. The website to learn more is www.lumkasturman.com.
Thank you for joining us for this deep dive into securing your South African legacy. We hope this has transformed your understanding of the power of a properly structured trust.